All right, everybody, we are going to get going with our last session of the day. So we're so excited to have Ashley Sly here. Ashley has been a part of the Gowan, Hurst, Clark & Smith since 2013. She has been in the public accounting profession since 2009. As a senior tax manager, her primary focus is on tax preparation, strategic planning for manufacturing, wholesale, and retail entities. In addition, she specializes in multi-state and sales tax use. Ashley has a firsthand perspective of small business as she grew up in her parents' auto body repair shop in Round Lake, Minnesota. She received her Bachelor of Arts with a double major in accounting and finance at Buena Vista University, and she currently lives in Van Meter with her husband, Matt, and her children, Jackson and Josie. And I will say personally, I have used McGowan, Hurst, Clark & Smith when I started my home-based bakery since 2010. So don't think you're too small to work with an accountant because they are awesome and they've helped me over the last 12 some years. So Ashley, I'll hand it over to you. You've got lots of great information to share and she will take questions throughout. So if you have questions, just feel free to drop them down in the chat and we'll get them up to her.
Okay, thank you, Christina. Yes, as Christina mentioned, feel free to ask questions along the way. Taxes are never a simple subject. So the more questions and the more clarification you get, the better it is for your business going forward. So we're just going to begin with some tax basics for beginning businesses. These are topics that we often see beginning businesses struggle with or just want to know more information about. So we're going to go through some basic foundations. In addition to that, I threw in some information that may be helpful, especially for home bakers, if that's your situation. A little bit about our firm. First off, we are located in Des Moines and Winterset. We have about 75 employees, and we are a part of a larger CPA network throughout the United States. So regardless of where you're located or where you may have tax issues at, whether it's New York or California, we're able to help out because of that alliance. Our agenda today, we're going to cover, first off, entity choice. So how you're structured as a business. We're going to discuss tax deductions, so those expenses that you can take on your tax return. We're going to cover the various types of taxes that you will incur. Sales tax, some record keeping, how to keep track of your books, tax estimates, and then talking about professional resources that may be available to you. So starting off, let's talk about entity choice. Entity choice really is how are you structured as a business? There's several different approaches that you can take on this, and what it determines is who's involved in your business, and then also how you are seen in the eyes of the IRS and what they're expecting from you in terms of when you go to report your income to the IRS. So let's start off by discussing sole proprietorship. Sole proprietorship is often referred to as a Schedule C, and this is because the Schedule C is what is included with your individual tax return when you go to file. It's really the simplest form of business. It's as easy as me going out and setting up a table out on the street corner and starting to sell lemonade. There's nothing really for me to do from a legal standpoint. Now, this isn't looking at like city permits or anything like that, but from a tax standpoint, there's nothing for me to do to open my own business. There's no separate tax filings. It's just one additional schedule that I include with my individual tax return. That's due April 15th. So I just report all of my business information on there. I really have complete control and flexibility of the business. It's mine. So anything from hours of operation to, you know, what purchases I make for the business and how I run the business. In addition to that, I can take cash out of the business with no tax consequences. Now, when I say that, you do have tax consequences on the net income that you generate from that business. But as an owner, I can pull that in and out as I wish without an additional tax being added by the IRS. However, with that simplicity also comes some disadvantages. First off, you're personally liable for business debts. So this means if my lemonade stand example, if I go out and buy a $20,000 lemonade machine and I find that I'm not selling enough lemonade to cover it, if I financed that machine, creditors could come after not only the machine, but they could also come after my personal assets if I wasn't paying my debt. So that means my house, my car, my checking account, whatever's in my checking account, all's up for grabs by those creditors. Now, one way around this is that you can, in Iowa at least, you can be organized as a single member LLC, which adds a little bit of protection when it comes to personal liability. But with that, you do need to work with an attorney, or it's recommended to work with an attorney on that. Other disadvantages of sole proprietorship: it's oftentimes harder to raise capital from banks and other sources, especially if you're looking to not be liable for those debts. Banks just, if you don't have the collateral, it's harder for them to loan out money. With this type of business structure, you are subject to self-employment tax, which is a tax in addition to net income tax. So this is 15.3% that's added on when you go to file your tax return. If you were running health insurance and retirement deductions through your business, these also could be limited based on your net income generated. Here's an example of the Schedule C form. This is from 2020. However, it's been unchanged for the last 5 to 7 years. It starts with just some general information. About a third of the way down, it shows income, so that's where you report all of your sales. The next section is expenses. So these are just some general categories the IRS suggests. You list your expenses there. If you have other expenses, those can be attached on an additional schedule. And at the end, you come to your revenue minus your expenses equals what your taxable income is, net income is, and that's what you'll be taxed on according to your individual tax rate. So another type of entity structure that you could be would be a partnership. Partnership is a collaboration between two or more parties. So it's bringing together multiple owners into a business and sharing those profit and losses from the business. Advantages of a partnership: it's easier to raise capital, relatively low startup costs. Again, recommend working with an attorney to draw up the appropriate paperwork. It's available, you can have between 2 to an unlimited number of partners. So if you had, 3 partners, that would be fine. You can have, 500 partners, depending on what the situation is. You have the opportunity to split income to result in tax savings, a tax savings strategy, so to speak. So what's meant by that is there's certain partners out there who may want to invest in a business and just take, so to speak, take advantages of any losses that may occur during the first years, especially as you're starting up. It's likely you're going to have business losses. Those partners will want 100% allocation of those losses, while the other partners may not get anything until income is generated by the company. So just be aware that there's different ways to structure that in this case. And as you gain employees in your company, there isn't a way to make an incentive program for them, for those employees to be eventually become partners in the business as well. Disadvantages of partnership: again, you still have liability of the debts. It's really unlimited, and it comes back to your personal debts. You do have an additional tax filing of a partnership return. You're still having to pay that self-employment tax. From an administrative standpoint, you have multiple individuals making business decisions, which can be a little bit of a challenge, especially if
views aren't quite aligned, that can become a challenge. And then as you have partners leave or join the partnership, depending on the situation, you may have to value all of the partnership's assets in order to appropriately treat the change in ownership, and that can become costly over time. Another type of entity is called an S corporation. This is similar to a partnership where it's called a pass-through entity, and I guess I forgot to mention that with a partnership. By a pass-through entity, it means that there's a business entity that reports the business's net income, and it's not taxed at the partnership or S corporation level. It actually flows down to those partners or shareholders who own the company. So they then in turn report it on their individual tax return. So partnership and S corp are similar in that aspect, but there are a few differences between the two. With an S corporation, you can have up to only 100 shareholders, and there are some restrictions to that, such as they have to be US citizens and a certain type of entity. The main advantage compared to a partnership is that with an S corporation, you are able to save on some self-employment tax. And the way around that is with an S corporation, the shareholders have to pay themselves a reasonable wage. And a reasonable wage is what you would pay another individual to come in and do those job responsibilities that you are performing. There can be one shareholder in an S corporation, so it can be a one-man shop, so to speak. It's easier to raise capital because you have the opportunity to sell to multiple shareholders and bring in capital from that standpoint. You're able to take cash out of the business tax-free, subject to certain limitations. It's easy to sell and transfer the business through that shareholder ownership. And one of the biggest things is you're not personally liable for business debts because there's that legal separation between the S corporation and your personal assets. Disadvantages, as mentioned, owners are required to pay themselves a reasonable salary. The disadvantage of this is that there's administrative work that goes into this. So you'll have to do quarterly and annual payroll filings. There is an additional tax filing. There's a separate tax return that needs to be filed. In addition to that, administrative burdens with setting up the S corporation. Again, advisable to work with an attorney, and also you'll have to register with the Secretary of State. Certain fringe benefits, this is health insurance and vehicle deductions, are limited to those shareholders who own more than 2% of the business, and they are more difficult to form than a sole proprietorship. And just to mention, because this sometimes gets brought up as I talk about these different entity types, there is another entity out there called a C corporation. These are similar to an S corporation where owners hold stock, but the difference is the entity itself is taxed as a separate legal entity. And due to the complexities of a C corporation, they're not an ideal choice for a startup and smaller business. C corps are usually what we see on the stock exchanges. So once you have your business entity set up, or at least what you want to be for the time being, you're going to have to consider what you will be reporting on your tax return. And part of what you report on your tax return is your tax deductions. So let's discuss some common tax deductions. The IRS gives a definition that a tax deduction must have a business purpose and must be ordinary and necessary. It's a little bit vague, but they do provide additional guidance to help businesses determine what is appropriate. And just a reminder at this point, your revenue or your sales minus your deductions, expenses, equals your net income. Now, the IRS has the authority to regulate what expenses are really allowable. So there's some expenses that your businesses may pay, but the IRS doesn't allow it for tax deduction purposes. One of this that we'll get into a little bit more is entertainment expense, for example. Since it's not allowed by the IRS as a tax deduction, sometimes your business net income or your book net income can be different than what's actually considered taxable income on your tax return. So some common tax deductions are anything from advertising expense, bank charges, fees, training, insurance expenses, gifts to clients. Technically, these are limited to $25 per person per year. This amount has not been adjusted for inflation since the 1970s, so it's a little out of date, but still something to keep in mind. Interest expense, legal and professional fees, office supplies, rent, and utilities if you're renting or owning an office space. Travel, it is deductible if it's for a business purpose. In a few slides down, we will get into personal vehicle usage and how that plays in. But just travel, say you're going to a conference in Miami, that would be deductible. In that same situation where you say you're going to a conference in Miami and you decide to stay a couple days, those additional days that you're staying on your personal time still maintains the deductibility of that round trip ticket to and from Miami. Life insurance, if the business is the owner on the policy, for you or any officers, it's not a deductible expense. And dues and subscriptions are mostly deductible. The one thing that you do have to watch out for is that no portion of the dues is considered lobbying expense, or if it is, this needs to be broken out because the IRS does not allow lobbying or political expense as a deduction. Baking supplies such as flour, sugar, any ingredients of that nature is considered part of your cost of goods sold. So this is a way to expense as you use the product. It does require some tracking of inventory to match the cost of goods you're using to make a product to the revenue that you're receiving from that product. So a good example of this is, let's say on December 31st of 2021, you purchase a gallon of vanilla for $300. You're not able to deduct that full cost, that full $300 in the year 2021, unless you happen to use it all. But let's say you use it periodically, over the course of 6 months. So in 2022, you would be able to deduct the full amount, assuming you used all the vanilla. Let's say you don't use it that frequently and only a half a gallon is used, and you still have half a gallon left at the end of 2022, you would only deduct $150 in the 2021 year. One thing to mention.
Can I ask a question?
Yeah.
Sorry, I was looking for the raise hand function. I didn't see it.
Nope, you're fine.
How do you, that's I've never heard that. I hadn't heard that until this moment. So how do you recommend that for things like spices, or like vanilla is a great example because we are using it. If I could purchase it in June and maybe I have like 3/4 of the way done by January 1st, 2022, how do you recommend that your clients do that? Because that entails a lot of careful tracking on our end, especially as small business owners. I'm like, oh my gosh, I hadn't considered that.
Is considering your materiality. So, in this example, $300 is a substantial amount and a gallon is a substantial amount. At least I in my thinking and working with smaller businesses, this would be, something a little bit more easy to track. As far as spices, if you're spending $10 on a bottle of spice, it's probably not worth it to track inventory in that case. Now, if you're buying things in bulk, that's where you would probably be more likely to track that inventory. So, if you're buying a pallet of flour and you're able to track, well, in 2021, I used 5 of the bags, there's 20 bags left. It'd be more in those terms, if that makes sense.
Mm-hmm. Yeah.
So I would
Is the same go for like butter? It's a weird
Again,
example, but like I buy butter in bulk, so yeah.
I guess one way to go about it is to think about what, maybe set a cutoff of, if it's $100 or less, I expense it. If it's $100 or more, and I'm just throwing out $100 here, I think it would really depend on the scale of your business. If it's a product that I'm spending $100 or more on, I'm going to track inventory on it. So again, if you're buying, hundreds of dollars of butter and you're not using it all in 1 year, you might want to estimate at the end of the year to say, well, I spent $500 on all this butter. I still have approximately $100 of butter left. So I'm not going to be able to take $100 of that deduction in 2021. It'll roll forward to 2022 when I actually use it. So again, I think the main point on that is maybe think about materiality and then the scale of your business, of what the product you're purchasing it, how much you're purchasing, if that makes sense. One thing I do want to mention is personal supplies and business supplies should be separate. They shouldn't be mingled together. Telephone and internet expenses, if you have completely separate business lines, if you have a separate business cell phone, separate internet line for your business, those are fully deductible. When you have a business and personal cell phone, it really needs to be split according to usage. So if you use it 8 hours a day for business and the remaining for personal use, you want to allocate it according to that percentage and have some sort of documentation on how you are splitting that, and then use that percentage when you're going to deduct the usage for personal or for your business return.
Sorry, can I ask a question on that too?
Yeah.
Since most of us on this are home-based businesses, so we're using our home internet and our home phones too, and I would say that the majority of us are running our business off of the internet. Is there how do you calculate the percentage at which you use your, like, how many hours a day? If I anticipate that I work 4 hours a day on my business, 5 days a week, so 20 hours a week I'm working on my business. I'm also using my phone and internet for that. Is that sort of the calculation, or
that is
and then I know
there isn't.
I'm just wondering if.
Oh, go ahead. Sorry, I'll let you finish.
No. I feel like these are the kind of little details, since it's very hard for us to separate the two, since it is in our home.
Right. And unfortunately, the IRS doesn't provide any concrete guidance on this, especially the telephone and internet usage. They haven't provided any additional guidance on how to do this. So as you mentioned, you can track hours, whether that's hours per week, hours per day. To be honest, I do have some clients that just say, I really use my phone 60% for business, 40% for personal use, and that's what I'm going to stick with. That's fine. I haven't, nor have I seen anything out there that this has been frequently flagged by the IRS. So I think if you have some sort of method to back what you're doing, I think it's probably acceptable at this point until we get additional guidance. What I wouldn't recommend is taking 100% of your business and internet usage if you are using for personal use. So again, I know that's a really gray area, but there isn't a lot.
No, that's a great answer. We're used to working in gray areas as home-based businesses, so
yes,
you just keep giving us. We'll find our way through.
Okay, good. We're on the same page then. I mean, there's a lot of different methods and approaches you can take to these things. What I will try to mention is what the IRS specifically says, what the IRS specifically doesn't say, and what might be in between is kind of gray area. And that's something that I guess what I want to steer you away from is especially the things that the IRS already said, no, you can't do that. But yet you go out and say, look at a website that's providing tax advice to small businesses, and they say, oh, no, you can do that. No issue. A good example of that I'll just throw out there as an example is that for a while, it was really popular for the tax advice to be, if you put a vehicle wrap on your vehicle, or if you have inventory in the trunk of your car, regardless of how you use your vehicle, if you're going to kids' soccer practice, it counts as vehicle mileage because you're either advertising your business or you are carrying inventory in your trunk in case you happen to come across a sale. The IRS said, no, you can't do that. That's not allowable. So that's a good example of what's on the internet isn't always correct. And that's what I'm trying to guide of, here's what the IRS specifically says, here's what it doesn't. Things in between is kind of a gray area. And speaking of that, let's talk about some unique tax deductions. So meals and entertainment, as kind of mentioned briefly earlier, there's specifics on how you can deduct these. Prior to 2021 and in 2022 and going forward, meals are only 50% deductible. In 2021, meals are currently 100% deductible for tax purposes, and this was as a way to stimulate the restaurant industry in the United States. Examples of meals expense include taking a client or prospect out to lunch, dinner, traveling for a conference or education, networking in the community, whether through a chamber or like network coffees, those types of things. 2021, 100% deductible, otherwise usually 50% deductible. Entertainment, beginning in 2018, became 100% non-deductible. So you can't deduct it for tax purposes. This is anything from ranging to sports tickets, country club dues, golf, concert tickets, etc. Cannot deduct them on your tax return. Vehicle deductions. If you're personally using your vehicle in your business, there's two methods to have a vehicle deduction they're able to take. The first is the standard mileage method, which is the easiest of methods because you simply take the business mileage driven for the year and take that times the IRS issued mileage rate. For 2021, it's 57 cents. And this rate fluctuates, it goes up or down year to year, depending on fuel prices, the economy, etc. With this method, you do want to log your mileage. So you do want to keep track of if you're traveling, say you're making a delivery, you want to track, I traveled 10 miles for client X on September 14th and keep a log of it. It could be a paper log, you can use an app like Mile IQ, Hurdler, QuickBooks Self-Employed has one incorporated in their platform. I've seen other clients use their Outlook calendar to create something since there's locations on the calendar. Essentially, the purpose of the log is you don't want the IRS to come in and audit, and because you don't have any documentation of your business mileage, your vehicle deduction gets completely thrown out. And this is considered like a hot topic by the IRS, as it is something that they often do kind of do a red flag on. The second method for a vehicle deduction is actual expenses. So this is taking your business mileage for the year, again, tracking that, divided by your total mileage and coming up with a percentage. So say that you use your vehicle 60% for business. You would then take 60% of your actual business expenses. So this includes gas, vehicle repairs, your license, insurance, parking expenses, and then also some depreciation expense on your vehicle. What we've found is that typically the standard mileage method tends to be a little bit more beneficial and is simpler to use. However, it does come to a certain point. If you use your vehicle for like 6 or more years, sometimes the actual method becomes more beneficial over time. My advice is maybe the first year of owning your business or using your vehicle, kind of keep track of both methods and see what, first off, see what you actually can keep track of, because I know some people start off and start keeping gas receipts and then just get lost in the number that they have and go to the standard mileage method. So see what you're able to track, and then that first year you can also do a little comparison on your own, or your accountant can, to see what method is more beneficial. Home
The
office.
vehicle donation, sorry, I'm going to jump in
Yep.
real quick, and I know we only have a short time left, but does the percentage of personal to business apply to the vehicles as well?
For the IRS standard mileage method, the first method?
Yes, or the like, yeah,
It
or
does.
the actual expense. Okay.
Nope. So for the standard mileage method, you're simply just keeping track of your business mileage. Your personal mileage does not matter in that case.
Okay, but the actual expenses, if you do that, do you have to take?
Yeah, you would have to factor in, basically with your actual expense, on January 1st, you'd want to record what your odometer says as of that date, track your business mileage throughout the year, and then look at your odometer on 12/31. And that would be your total mileage. Subtract out your business mileage, and that would be your personal mileage.
And then there's one question that came in that says, does business mileage include store runs when you might be buying personal and business items?
So that's a little bit of a gray area. I think it would probably, that's a gray area. I think it would depend on how you want to classify it. If you're mainly going for business purposes, I think you would want to classify it business. If it's more on the personal side, I don't think you would factor it in. If it's, I think in those cases, you'd really want to pick one or the other of what the majority of your vehicle usage is for in that case. Home office deduction is another unique tax deduction. It's available to self-employed individuals whose primary place of business is located within their home, and the home is really used on a regular basis for business purposes. So right there, especially, as we're working with COVID and a lot of remote workers, if you're a remote employee, that's a W-2 employee working for another business, the home office deduction is not available to you. So it really comes down to people who are running the business out of their home. The area for the IRS to have this qualify as a deduction, the area really must exclusively be used for business purposes. So if you're using your home's single kitchen as a business office, this really isn't going to be accepted by the IRS if you also use it for personal use. There's no 50-50 usage. In the IRS's eyes, it's either all or nothing. So if you have a second kitchen in your house that's used exclusively for your business, this would be considered an acceptable business office, and you'd be able to deduct that portion. In addition to the kitchen, you would also want to consider if you have an office where maybe you're doing bookkeeping, if you have a storage area. Essentially, if it's a space exclusively used for your business, it'd be considered part of your home office deduction. Similar to the vehicle deduction, there's two ways of calculating a home office deduction. There's the simplified square footage method, and this is taking the square footage of your business use area times $5 per square foot. And you can only go up to 300 square feet when using this method. The second method is the actual expense method, which again is taking your business square feet of your home divided by the total square feet to determine what your percentage is, and then using that percentage and applying that to utilities, repairs, mortgage interest, insurance, property taxes, depreciation. There's a number of expenses, home expenses you could add to this list. Again, there's an importance of accurate records. You need to make sure you have the appropriate square foot footage calculation, and with the actual expenses, keeping actual track of your monthly utilities, of any repairs that you're doing, and keeping documentation of those things. Depreciation. So I don't foresee this being a huge issue, especially starting off as a smaller business, but depreciation is really when you purchase something for, typically the range is $2,500 or more. You need to take the value or the expense of that item over a period of time. So for example, for a business that maybe has an office, a conference table, it costs $10,000. That $10,000 should be expensed over the life of that conference table. So the IRS says that conference table has a life of 7 years. There's a calculation to spread that $10,000 over the course of 7 years. Again, this applies to assets that usually cost $2,500 or more. So as we discussed, office equipment, furniture, larger appliances. If you're buying a professional oven, mixers, things of that nature, those items would be required to be capitalized, and typically those are over 5 years that they would be capitalized. If you decide to go to buy a building, the building structure itself, along with any assets within the building, would have to be depreciated. And again, the IRS provides those guidelines on the calculation and the life of the assets. Currently, there are 2 ways to accelerate that depreciation in the year of purchase. There's what's referred to as bonus depreciation, which allows you to deduct 100% of the cost in the year of purchase. This can create a taxable loss if you use this method. There's also what's called Section 179, and this is available for 2021. You can use up to $1,050,000 of an amount provided by the IRS to expense assets in the year of purchase. There's a little bit more flexibility with this method. However, it cannot be used to create a taxable loss. Jumping over into sales tax. So before we get started, just remember that every state has their own code on sales tax. So every state is different on how products are taxed. We're going to specifically talk about Iowa. Iowa, bakery goods such as breads, cakes, really flour-based products sold by the seller that baked them are exempt from sales tax. So you do not have to collect or remit sales tax on products that you sell. This applies also if you're selling for consumption on the premise. So say that you go to, you open like a pop-up bakery for a day and people are eating on location because you have picnic tables set up, does not generate the need to collect sales tax. Some other tax exempt items, and the Iowa code gets into specifics on what types of products are and are not taxable. So they're tax exempt items: jams, frosting, crackers. Things that are taxable: candy, caramel, marshmallows, ready to eat popcorn, and granola bars are just some of the ones that are listed. again, there's a long list of things that you do want to get familiar with if you are selling more on the candy side or non-bakery goods. Make sure you're complying with the sales tax code. If you find that you do need a sales tax permit because you are selling taxable goods, you'll want to apply for one through the Iowa Department of Revenue. And then at that point, you'll need to start calculating sales tax, both state and local tax. Currently, Iowa has a overall state tax of 6%. And then if you're located in like Polk or Dallas County, there's also a 1% local tax that you need to collect as well. So you'd be collecting these from the customer. And then either on an annual, quarterly, or monthly basis, you would need to fill out sales tax reports and remit that sales tax to the state of Iowa. And the frequency of those filings is really dependent on how much you're expected to collect in a year. And that filing can change depending on what you actually do end up remitting to the state of Iowa. One thing that I do like to throw in there is thinking about retirement. One of the huge advantages of owning your own business is the opportunity to really set aside a large amount of money for retirement. So when you're a W-2 employee, you're really limited to $19,000 that you're able to put into kind of a tax advantage retirement plan. When you're a small business, you have the opportunity to put up to $58,000 or 25% of your net earnings from your self-employed income towards retirement. And there are some various plans out there. They have their pros and cons, but do understand that that's a huge advantage of owning your own business, is the opportunity to set aside money for retirement. So it's just something to be aware of. I do want to discuss the types of taxes just as a little bit of a refresher. And I feel like this is an area that especially people new to owning their own business can get confused about easily. So let's just talk through quickly the different types of taxes. There's income tax, which is both federal and state tax. And this is assessed on your business net income generated. It's taxed when you go to file your individual tax return. And this applies to whether you're a sole proprietorship, a partnership, or S corporation. It really, where you're paying tax at is on your individual tax return. The rate that you're paying is dependent on your household income. So you have to factor in your spouse's income as well into what your tax rate may be. If you're a sole proprietorship or a partnership, you do have to consider, or you will be assessed self-employment tax on top of that. And this is in addition to income tax. Again, it's assessed when you go to file your individual tax return, and the rate is 15.3%. One way to think about this is that when you're self-employed, you are the employer and you are the employee. When you are a W-2 employee working for another business, you are really just responsible for the employee portion. So you're only paying half of that 15.3%, and that's withheld from your paycheck each pay period. When you're self-employed, again, you're the employer and the employee, so you're responsible for both portions, and that's where that 15.3% comes into play. Sales tax. This is tax charged and collected from your customers, depending on the taxability of your product sold. And this is collected by the state where the product is sold at. Payroll tax. If you're paying yourself or others a wage, you need to remit payroll taxes. And this kind of goes back to the self-employment tax. Again, it's separate situation. For self-employment tax, you're really paying for yourself. And payroll tax, it would be if you have employees, including if you're considering yourself an employee and paying yourself a wage. You need to remit payroll taxes. And this is done on a quarterly and annual basis. So something to be aware of. Tax estimates. When you're self-employed, the IRS expects you to make quarterly estimates, not only the IRS, but also the state that you're located in. So Iowa, for example, they require you to make quarterly estimates. For federal, these are April 15th, June 15th, September 15th, and January 15th of the following year. By paying estimates, you're avoiding penalties, and you're also helping your business's cash flow because you're paying the tax throughout the year as you're generating cash, and you're not just waiting until your tax return is due and have this large lump sum that's due on April 15th of the following year that you might not have the cash flow for, or you might not have made appropriate plans for. Depending on your household income, we typically recommend setting aside between 30 and 35% of your net income each quarter and using this amount to pay towards your quarterly estimates. We really recommend maybe setting up a separate savings account where you put that money into. So it's kind of out of sight, out of mind until you go to make those estimates. And this helps with, as you're looking at your business checking account, what you're seeing in there is really what's available for you to spend. That tax estimate isn't in there as well. It's kind of in a separate place. So, what you see is what you have to work with for day-to-day business operations. It's important to be aware of income tax return deadlines. If you're organized as an S corporation or a partnership, those tax returns are due March 15th. Your individual tax return is due April 15th. You do have the option for a 6-month extension, but this is only extension of time to file, not to pay. The IRS still expects their money on April 15th. Even if it's just an estimate, they would rather have you pay way more in than what you should than not pay at all. Because if you don't pay it at all, or you don't pay enough, you will receive penalties and interest. Talking about accounting systems. As you become a business, it's important to keep track of records and documentation of your business activity. There's various ways of doing this. What I really recommend is find a method that works for you and that you're willing to do on a consistent basis. QuickBooks Online is a very popular option. It has a number of capabilities for not only tracking your business financials, but also keeping, if you do have to keep track of inventory, you can do that from there, as well as bill clients. Xero, Wave, and FreshBooks are also popular options. I'm not as familiar with those three. I have been warned that some of them do start off as free software systems, but after a certain number of transactions or a certain revenue threshold, a subscription service does start. And at that point, it can be difficult to get your information out of that software and transfer to something free again, if that is what you're looking for. An Excel spreadsheet also works. Really, again, it's what you're comfortable with keeping track of and what works for your personal system. One thing I would stress is to have separate business and personal bank accounts. This is really important. You don't want your personal and your business financials mingling together. First off, it's hard to keep track of where your business is at or even your personal records. The other reason is if you should ever be audited by the IRS or the state Department of Revenue, you do want to narrow what they see. So if they're auditing on your business, you really just want to give them business information, and you don't want your personal information mingled in there as well. Vice versa if it was the other way around. It really just helps from an operations standpoint, and then, farther down the line if an audit were to be the case. Professional resources. So really, I would recommend, and again, this is kind of a self plug, so I apologize, but consider hiring a CPA. A CPA is a certified public accountant. We're licensed by the state, and we are required to act ethically in the best interest of our clients. I will say taxes are complicated and laws are frequently changing. A good example was 2020 with not only 2020, but 2021. There were a number of COVID bills passed, and the amount of tax changes and legislation within those bills was ridiculous. It was hard for us to keep up to date on those changes. So it's especially hard for someone who's not as familiar with tax, and it isn't part of their responsibility to look at that on a daily, weekly, monthly basis. CPAs can also help with financial analysis. And the other big thing is we can help with notices and audits. One of the things that we're also seeing from COVID is that especially states are being very aggressive on generating new revenue. So Wisconsin is a great example of they are finding businesses located out of the state of Wisconsin, and they have some sort of method for determining that there may have been some activity from, say, an Iowa business in Wisconsin. They will just send a notice to an Iowa business saying, you know, in 2018, we think that you did some business in Wisconsin. Here's a $1,000 tax bill. Okay, just randomly getting a $1,000 tax bill, or if it's for multiple years, which we've seen, getting a $5,000 tax bill from Wisconsin can be a little overwhelming, especially if you haven't done much in Wisconsin. What we're able to do is go in, and what we've done in some of those cases where they've received $5,000 in tax, we've been able to lower it to $100. We're familiar with what the laws, so we can kind of mitigate those. And sometimes the IRS and the state revenue departments are not always correct. So it's good to have someone on your side to be able to help with those types of things. Also really highly recommends professional legal guidance, especially if you're forming a business entity, such as a partnership and an S corporation. You really want those set up correctly. And if you're going into business with others, it's really important that you have a sound legal document in case something were to ever happen. And with that, are there any other questions? I know we covered a lot.
I have a question. I have a separate business banking account to my personal banking account. I don't earn any other income except for what I sell through my business. So to pay some of my personal bills, I just transfer money from my business account into my personal account. And I just kind of record it as a draw.
Yep.
Is that considered a payroll, or is that considered an expense, or how does that work?
I'm assuming that you're set up as a sole proprietorship where you're reporting as a Schedule C.
It's a LLC, single member LLC.
Okay, so in that case, you are reporting on a Schedule C.
Okay.
That's where, yes, you can take cash out of your business and it would be considered a draw. It's not payroll. For you, it would be just a business draw. You are paying yourself, but it's not payroll. You're taking the cash you earn from your business and you're using it, you're taking it out and transferring it to your personal account. That's perfect.
Okay, good.
Ashley, I think the only other question that I got from somebody who's not on today was about, and you kind of just touched on it there about other states, but knowing the tax, if they're selling online and shipping to another state, best practices for keeping track of all that.
So that has become another tricky subject in the last couple of years. There was a Supreme Court case that involved the company Wayfair. It was between South Dakota and the company Wayfair, and it changed the sales tax landscape. Essentially, small businesses were somewhat protected because if you are selling less than $100,000 in another state, or have less than, and again, it varies by state, between 100 and 200 transactions. If you have fewer than those, you're not necessarily subject to tax in other states. But if you're selling more than that, you may be liable for both sales tax, and there might be some income tax exposure. There's a number of ways to track that, whether it's keeping track in an Excel spreadsheet of where you're shipping to, or if you're selling on some sort of sales platform, they're usually tracking your sales by state numbers. And that would be something to discuss, of whether, again, you have sales tax or net income tax exposure.
Okay, perfect. I don't think they're going to hit the limits, but it is a question I'm starting to get a lot of, because our state doesn't charge on baked goods, but some states might. So I just recommend they reach out to an accountant that can help them through that. I don't think they'll hit the numbers, but again, each state has different numbers.
Each state has their own rules, not only on what's taxable, but also on what their threshold is. So that can be a very tricky subject. I would recommend reaching out if you feel like you're making significant sales in another state.
Okay, we did have one question. If using the standard mileage method, using the IRS 58 cent per mile, do we need to keep receipts for gas?
No, don't. You're just basing it on the documentation of your mileage log.
Okay, perfect. Well, I don't see any other questions in there. I will be sharing your email. We did have a request for the presentation, Ashley, so I'll follow up with you on the backside of that. But again, there's all of McGowan stuff, and I can't say enough about them. I started with McGowan myself in 2010. No clue what I was doing. Tiny little bakery, and they've been with me ever since. So can't say enough good things about. Doesn't matter the size, as Ashley said. They just want to get you on the right foot, and honestly, down the road, it makes such a difference. So, Ashley, thanks so much for being here today. We really appreciate it.
Well, thank you. Good luck with everyone on your business adventures.
All right, guys. Well, we are rounding out the day now. I just want to throw out just a couple announcements kind of to wrap us up today. So this is being recorded. It will take us a little bit of time to get the sessions edited down. As you can see, we took breaks and things like that. So we will get the sessions edited down and out. We will have the resources. I've kept track of everything that everybody dropped in the chat. I've had a few emailed to me as well. So I will make sure I get a follow-up email out to you guys as well. Hopefully you were able to meet some fun people in the breakout today. Again, your reminder on your goals. We'll be checking in with you next week. First thing in the morning, we'll put you in a group and let you guys discuss and see where you're at. I did want to mention this was supposed to be in person, and we do have swag bags of stuff for you guys. So in my follow-up email to you, I'll be asking if you would like me to ship one to you. Shipping will be free, but there is some fun little things in there for you as well. And then in the additional email that I'm sending out, the farmers market, the Des Moines Farmers Market, is housed out of the Greater Des Moines Partnership. I will be sending information out on that. And then we did have some information as well on a gingerbread house competition coming up to benefit Blank Hospital as well. So I will just stick that in the email in case you were interested.